So balance sheet, what to look for. So that's the definition of a balance sheet. Look for the current ratio we talked about, debt to equity ratio we talked about, and price to book we talked about. Current ratio, ideally 2 or higher, at least above 1. Debt to equity, try to keep it low. Under 1 is ideal. If it's 7, then they have a lot of debt. Price to book, it'll be somewhere around 1 or 2. If it's any lower than 1, you're kind of scratching your head, what's wrong with this company? Compare it to its competitors and to its sector. Okay, income statement, what to look for. Definition of an income statement. Look for the price to earnings, price to sales ratios. Increasing revenues, increasing earnings. We talked about decent cash flow. Girish threw in there. Fair value. So fair value is an analyst forecasts of a company's future cash flows and earnings to arrive at an estimate of a company's intrinsic worth. So basically, what are we expecting to come out of that company that sort of aligns its fair value? You can throw in there its overall popularity, its brand name recognition. Everybody knows Microsoft, everybody knows Apple, everybody knows Coca-Cola. That's worth X dollars in the stock price. So the fair value is the price target that the company's stock should be at today if that expert was right in his or her evaluation. Some people will, and everybody has their own opinion about the fair value. You talk to different experts or read different experts, everybody will have a different one. Some people will say, okay, when we hit that, I'm selling half of the position. So that's up to you. You might want to do some research about some of these rules and triggers for when to buy and when to sell. Write them down and stick to them, no matter what actually happens to that stock. It would be a good guideline. Markets are not always efficient with external temporary forces affecting the stock price. So today's price is not always fair. And people are people. They get a piece of good news, meaning there's a possible cure for COVID and the stock price shoots up 10%. Or COVID increases in the number of cases and the stock market loses value. So there's a lot of emotion built into it. I would suggest to sort of park yours at the door. Read the last annual report and the stock analyst reports. Get familiar with the company. When you get an annual report, it is half an inch thick. That's I would at least glance through it. Keep up with the news releases. Okay, dividends and yield. So companies return some earnings back to their owners via dividends. Make sure the dividend is stable or increasing. As I showed you, BMO seems to be increasing at roughly 6% a year. Those that increase it are called dividend aristocrats, and there's ETFs that you can buy that are called dividend aristocrats. This is something most people don't really think about. Dividends aren't free. A $10 stock that pays a $1 dividend is now a $1 stock and $1 in cash in your pocket. There's a lot of movement in the stock price, but on the day that the dividend is announced or paid out, I can't recall which, you see the stock price drop by the amount of the dividend. Now you can't tell that it's the dividend that did it because it might be an up day and the stock's price still goes up overall. But a lot of people psychologically, retirees, they want to have a whole bunch of stocks that pay them dividends, and they feel really good about not depleting their principal. and they're just sort of living off the interest, they're living off the dividends. They could get a stock that doesn't pay a dividend and then sell 10% of it, and next year sell 10% of it again, and if it keeps going up, their principal isn't going to be decreasing either. So it's sort of a feel-good thing, but just be aware dividends aren't pulled out of the air. They do come out of the assets, out of the balance sheet.
Hey, Alec,
Yeah,
can I make a small comment on fair value
of
so that
course.
people get? So, most people look at fair value as the underlying intrinsic value of the business itself.
Yeah.
And most people I talk to and I've listened to, and myself, uh, do something called discounted free cash flow analysis, meaning that you just don't look at how much free cash flow that the company had generated recently, which is in 2019. You look at the history of free cash flow returns in the last 5 to 10 years. So you're really covering a really long period where you know that this up increase or decrease in free cash flow is not a short-term event, right? It's actually been occurring over the last 10 years. And you look at the average cash flow, free cash flow for the last 5 years, and then you predict what the growth rate has been for the last 10 years, and you see if that growth rate is maintained over the next 10 years, how much free cash flow the company is going to generate, right, in its lifetime. And then each cash flow, annual free cash flow, is discounted at the rate of discount rate. Now, what is discount rate? Discount rate could be whatever the yield on corporate bonds is, which is probably 3% today, plus inflation, which is 2%. So you're discounting each of your annual free cash flow at the discount rate of 5%, and you're coming up with a present value of future cash flow that the company is going to generate in its lifetime. And that kind of gives you a pretty good fair estimate of how much net cash, discounted at the discount rate today, is going to generate in its lifetime. And that's usually what people refer to as a fair value.
Mhm.
Uh, right, and you can look it up. There are different ways to do it. Just type in discounted cash flow analysis in one of the financial terminals. You can go to Bloomberg, if you can go to your brokerage. They give you a brief description of how it can be calculated, or you can look for other resources that people might have online. Okay.
Yeah, so absolutely, you can do the calculations yourself. I have to confess, I never have. I'll read the experts' opinions. Like Morningstar, for example, has an intrinsic value or fair value estimate. Uh, yeah, I mean, you look at future cash flows, and eventually, if you go up 30 years, it's basically zero because it's discounted so heavily because it's so far out in the future. Uh, so yeah, so that's stock analysis. I think there's other things built into it as well. It's not just the cash flow, but yeah. So theoretically, you should do that yourself, or you can have an expert do it for you. But every expert is going to have a different idea of the intrinsic value as well. So um, I mean, yeah, you can do it yourself if you don't trust the experts. Going back to the dividends, as I said, North American companies try to have the dividends steady and definitely avoid cutting them. If a company cuts dividends, it's likely the price is going to go down. But then the dividend yield sort of balances, because if you have the price is low, but they tried really hard to keep the dividends going, so you had 15% yield. They're gonna one day they just say, okay, forget it, we can't keep this up. We have to cut the dividend. So now the yield is gonna go back to the 5% or something, which is a little bit more reasonable, because now the dividend is cut, and the price likely stays the same because the price was already pricing in the dividend cut. Sometimes a company will cut the dividends out of desperation so as not to go bankrupt, and the price will actually go up that day because the market thought that that was a good idea. So But generally, when the dividend is cut, the price will go down. Right. This we talked about the price changes. So high yield companies are the riskiest. So please be aware of this. Don't look at something. It's like, oh my God, these guys have a 10% yield. That's pretty juicy. It's the opposite. The company's likely in trouble. So look at the payout ratio that we talked about, and make sure that it's and it's 40 to 60% ideally. Right. Other things to look for insider ownership. So if the CEO and the CFO of the company is buying the stocks, buying the stock of the company, it bodes well. So do keep an eye out for that. And on your brokerage site, it's very likely that they have, like Qtrade does, it shows how much is owned by insiders, and how much is owned by institutions as well. Institutional investors are usually big money investment companies, and they generally don't invest in bad investments. So it's also a good guide. And big investors, whether it's Warren Buffett or any other hedge fund guys or companies, they have to disclose what they're buying, because they're buying large percentages usually of the company stock. And so that's public knowledge as far as what they're buying as well. Company buying back its own stock. This is good for the investor as it drives up the price, but it's seen as financial manipulation by the CEO to increase the stock price. And it's especially bad if they borrow to do this. So we sort of covered that. Okay. Are we still good? I think this is 12 of 17. Do you want me to keep going, try to finish it off, or call it a day and reconvene on Tuesday? Anyone? We can finish? All right. I heard a Tuesday. All right. So somebody else break the tie. Good to go. And I heard a Tuesday. All right. Let's.
No, we can keep going. If I kind of miss something, I will actually play the recording again. So we can keep going. That's fine.
Okay. Dee, are you going to be able to absorb it?
Yeah, it's okay. Go ahead.
All right. Cool. I just don't want you guys to like be overwhelmed and not really get much out of it, right? All right. So professional mutual fund and money managers, they have price targets when they buy a stock, and they'll begin selling it when it reaches a certain price. So like before they buy something, they already know when they're going to start selling it. Like it's all predefined. There's no emotion. There's no ad-libbing mindset. So determine that trade versus investment. Be dispassionate. Be ready to admit when you're wrong and get out. Ask. So this is sort of an interesting thing. From this point on, is it going up? Everything is worth what the market is willing to pay for it, and it's worth what it's worth at that time. Nobody cares about what you bought it for. So just be clear about it. It's look at the asset as a dollar value, not that it's down 30%. There's no guarantee that it's going to go back up to where you bought it for. So I'll sell it once it goes back to what I bought it for. If you didn't own it already, would you expect it to go back up? So something dropped 50%. And they're like, you know what? I'm going to stick to it. You shouldn't. I'm going to stick to it until it goes back to what I paid for it. Well, pretend that you don't own it. Pretend you're going to buy it now. Do you expect it to double? because that's what going from 50% back up to 100% means. The 50% has to double. So basically it's worth whatever the market is willing to pay for it at the time. And you have to judge, is it going to go back up? Because if it's not, get rid of it. Get rid of it. Okay, buy or sell, there is no hold. So this is a little known Yoda quote. If you're a Star Wars, it was do or do not, there is no try. Anyways. No Star Wars people here. So basically keep only what you would buy today. I made somebody laugh. As if you didn't own it. So whatever you have. Yes, Indy? No? Okay. Whatever you have, look at it every day and say, is this a good investment? Would I buy this today if I didn't own it? Because a lot of people will hold on to losers just because they already have them and they don't want to admit defeat. So that's the wrong way to go about it. I mean, if you bought it as an investment and you still believe that it's going to go up, then this doesn't apply. In fact, if it went down, you would probably want to buy more. But if you bought it as a trade, then you know your 20% stop loss should have already triggered if it's down 50%. Anyway, ultimately, share price is about the company's earnings, and it follows earnings over time, or cash flows, which are somewhat similar with the depreciation added back in. The market looks ahead, reacting at what could affect earnings, but it often misjudges and overreacts. Expectations are built into the price. So back some months ago, you had the US, Mexico, and Canada free trade agreement. The signing was expected, and so that's already priced into the market. So when it actually happens, the market doesn't care. It's already been priced in. It was already expected. So it's all about expectations. Number of stocks to buy, diversify and buy 10 to 20 well-chosen stocks, but no more. Anything past 40 stocks is basically following the index, and you've just made yourself a mutual fund that you now have to take care of. Large number of stocks means you can't do the research and you can't keep on top of them. Like I remember buying a stock and I went to a meetup the next day, and one of the person who recommended the stock the previous meetup said, "Oh, did you see the press release?" And I'm like, "What press release?" So that indicates that you just have too many stocks on the go and you can't look after them. So penny stocks, it's a share price is less than $1. So as I mentioned before, it's not necessarily bad. The stock probably got beat up because nobody goes public with a share price less than $1. Like they could price it anywhere. They could price it anywhere from you know, $5 to $10, $20, $50, whatever, but they won't price it at 50 cents. Yeah, I already mentioned that. Okay, other strategies. So dollar cost averaging we talked about with the mutual funds. So especially if you have a commission-free brokerage, maybe put your money in as you make it over time. It's a bit safer. Okay. There's a strategy called Dogs of the Dow. So you can do Dogs of the TSX as well. It just doesn't sound as good. So what that is on the Dow Jones Industrial Average Index, you can look and you can see which one has the high or which ones have the highest yield. So you'll pick the 10 out of the 30 stocks that have the highest yield. Now the yield means they're paying dividends, but their price went down, which is what made the yield be so high. Remember we talked about that. And so what that means is that they've been beaten up. And so if you buy them on January 1st and you sell them again December 31st of the same year, any of them that have made a recovery, and maybe some of them have, you will actually do quite well. It is a strategy. It actually seems to outperform the index by about 3%, if memory serves. And because they're paying nice dividends compared to how much you're paying for the shares, you might actually have some nice cash flow as well. So it is a strategy, something to read up on, see how it works. Tax loss selling. So this is the harvesting of a capital loss. So in a non-registered trading account, meaning cash account, not RSP, not TFSA, if you have a loss, you can write it off against the capital gain. And so, like I said, everything is worth whatever the market is willing to pay for it. So if you bought a stock and it went down a whole bunch, if you think it's going to go back up, you can either sell it and then harvest this capital loss that you've had, and then you get a tax benefit immediately. You can then buy a similar product now, or you have to wait 30 days by CRA and US rules as well. You have to wait 30 days and then you can buy the same stock again if you think it'll go up. But it's better to get the tax benefit now rather than hoping and waiting for it to go up, and then there's no tax benefit. And of course, if it goes past what you bought it for, it's a capital gain. If you think it'll go down, then definitely sell it. Okay, so that's tax loss selling. Everybody's sort of okay with that one. It's something maybe to Google. It's a strategy when you've lost money, and you actually want to take advantage of it rather than sitting on a stock that's lost money and nothing's happening with it. Using limits. So let me jump back here. So when I make a purchase, you can either buy it as a market, meaning whatever. Indy, your microphone is, I think. Yeah. Thank you. So you can either buy it as a market, or you can use something called the limit, and you can buy or sell using limits. So here's a company that is low volume, okay, and you can actually see what people are offering and what people are asking for. So here's somebody who put in a limit, says, I'm going to buy 25,000 shares of this. So actually, $30,000 worth. But I want to pay $1.20. The previous transaction was $1.30. But somebody who's holding the shares right now is asking for $1.50, and they're only willing to sell 6,000. So there's a big difference, and this is also a measure of liquidity, meaning, can I get my money out? If we look at BMO, there'll be a couple of pennies on that $70 stock. That's going to be the gap between the bid and the ask. On this guy, the gap is huge, and as you can see, the volume is very low. So if I put in a market order right now, thinking I'm going to get it for $1.30, actually I'm going to get it for $1.50, and that's only if I'm wanting to buy 6,000. If I'm wanting to buy more, there's probably more people here to the right at $1.60, at $1.70, or whatever. So my my purchase will actually be at least $1.50, and then if I'm buying a whole bunch of shares, it'll be more. So that's why you would want to do a limit order, meaning I am willing to buy this many shares for $1.35. Now that limit will then replace this guy because it's the closest, but there will not be any transaction. But you won't get any surprises. Okay, this should be, please understand this. If you're buying a frequently traded, so let's go back to the BMO. If you're buying a frequently traded stock, you're probably okay with the market. So let's look at the volume here. So 7 million shares traded hands, and okay, 22 cents. So that's actually a little bit more than I expected. But that's on a $76 stock. So if you're buying something that has low volumes, make sure you're using limit orders. Otherwise, you'll be like, oh my God, how much did I pay for that? Same thing goes if you're selling. You can also use limit orders, saying this is the least that I will take for the stock, because there'll be people who will be just lowballing it. They'll be putting in limit orders really low, hoping somebody's going to put in a market sell, and then they're gonna get the stock at a really cheap price. So just be aware of low frequency traded stocks. Any questions about any of this? Either the tax loss selling or the limits? Everybody sort of clear on that? Okay. Beware of value traps. So if there's a really low PE and a really low price to book, there's probably something wrong. Like it's just too good to be true. Also be aware of overpriced stocks where the PE is really high. Like I won't buy anything that has a PE over 40 or 50. Like that's just not something I want to get into.
Lesh, a quick question,
Yeah.
but one bullet point prior regarding capital gains, because I'm really new at this part. This is to get a next phase. Is say I trade it from I use a bank broker, but regardless of the broker, I sell for a gain. How is it under my discretion? Discretion is the wrong word. Under my responsibility to deal with all the accounting, or is there like a follow-up, like a statement that says you have capital gains according to this broker, and then like a T4? Like how do I keep track of this? Is this all under my own spreadsheeting?
They should give you a T slip. I think it'll be a T5. I want to say.
Okay.
T4 is for salaries.
Yep.
T3 or T5, one of those. Yeah, by law they have to supply you with it, and then of course they also send it to the CRA, and the CRA will compare electronically.
So they'll do the dollar cost averaging math then, because if I bought it over a period of time, let's say I bought an ETF in the an open cash account, and I bought like it over a year, and so I bought it at different prices, it's appreciated, then I sell it. Do they do my dollar cost averaging? Like what do they consider my profit?
Yeah, great question. So it is good if you track your own purchases and how much you purchased it for, because then when you sell it, you can say I sold this batch or I sold that batch. So you have control over how much capital gains you're going to be paying.
Oh, okay.
That's more of an accountant question, to be perfectly honest. It could be the information that they send you on the T-slips is first in, first out, or last in, first out. I honestly don't know. I've made life easiest on my accountant in that I always seem to sell the whole position. I don't sell a part of it.
Mm,
And in that case, the accountant will just sort of guess because he also knows how much I bought it for. So
okay.
so he'll say, okay, we did LIFO or FIFO.
Mm-hmm.
So if you're doing it yourself, the accounting, I mean,
Yeah.
um, then you would have to do the calculations yourself.
Okay. So it's not, to your understanding, at least the way you just described, it's not an average over time. It's like positions. It's like I sell a batch at this and a batch at that. It's
If
I,
not it.
yeah,
I,
Drew, do you know the
yeah,
answer?
Alice, I think it's averages, meaning that if you're buying one stock multiple times at different prices, for example, if you buy, let's say BMO at $34 per share and you buy 50 shares, and then you come back the next month and you buy 50 shares again, but it's dropped by $2 and you bought it at 32, then what's going to happen? You would see in our account 100 shares of BMO at the average price of $33, because the first batch you bought at 34.50, right? And
Yeah.
then the second batch you bought again 50 shares at $32. So it actually shows you the average purchase price of those 100 shares. So when you sell it, right, and if it goes up to, let's say, I don't know, $37, so and you sell half of it, then your capital gain is going to be that from the average purchase price of $33 to $37. So your capital gain per share would be $4. And that's how your brokerage software looks at it, and it gets reported on T5. It will come out at the end of the year.
Um, so I know for sure that they recommend that you keep track of each purchase separately.
Yep.
And you can either let it go the way you described, just whatever it comes out on the T4, and maybe it uses averages, maybe it doesn't do first in first out or last in first out, maybe it just uses the average. um,
Yeah, I don't know, Alice. I think these the brokerage that we have. I mean, I have a couple of them in Canada, and I also have in India as well. And they don't often do, unless you use different accounts, right? If you use RRSP, then it's different. If you buy 50 shares in RRSP and 50 in your non-reg account, and then 50 in your TFSA, then it's all separate, right? In three different accounts. But if you keep buying in your TFSA or in your RRSP, then it's gonna keep adding to the same account.
yeah,
That's usually how it works,
but
I
we're,
think.
yes, but so it shows you an average in your account. It shows you an average for sure.
Yeah.
When you sell it, however, if you're able to say, I sold this batch, your accountant will say, okay, you bought this batch for this much, you sold it for this much, this is how much you're paying in capital gains. You don't have to use an average. And to be honest, I don't know exactly what it shows you on the T-slip.
Yeah, if you want to do it individually, the software, the brokerage account wouldn't do it on your behalf.
Right.
You have to do it yourself. I mean, I keep track in Excel sheets. I know exactly when I bought it, at what price I bought it, and so you have to keep track for your own sake. But from the tax purposes, I think they don't care. Whatever the brokerage account reports, and on an average basis, whatever the capital gains are, that's what you would pay tax on.
Yeah, and my accountants never asked me which batch did you sell. I mean, it is because I usually sell the whole position rather than selling bits of it.
Yeah.
But theoretically, Kenny, you could say this is the one that I sold if you did keep track of it. Um, I mean, keeping track of it on a monthly basis is a little bit onerous, but if you're buying $5,000 worth, then you should know what you bought that batch for. And later,
Yeah. Oh, sorry. Yeah, no, I understand. I think that's why I think Resh, I've seen it that way, but I believe the accounting will allow for that. The only follow-on question I have is from Alesh, your point of view, like what evidence do you have to give the taxman that you bought it at that price, kind of thing? Because it's not on the T5, well, according to Goresh at least, it's not on the T5 statement. it might be. So
I don't think it is. The T5 might show an average, as Girish says. However, out of your brokerage, you can get multiple reports, multiple exports into Excel of all your transactions.
Okay.
And there it shows this is how much you paid in commission, this is how much you paid per share, and this is how many shares you bought. So all of that stuff is easily available. There's no paperwork really. It's all in Excel.
Yeah, okay. So as long as you can export those transactions as the proof, then that's fine. I think you mentioned this, but please remind me. For commission fees, are those tax exemptions or not gains, but like can you have tax write-offs on your transactions on a cash account?
Yeah, so they've actually simplified that. I think for the accountants, in that the commissions are counted as sort of part of the purchase. So if I bought shares for $10, I bought 100 of them. So what, 1,000? My cost base then is $1,007, where 7 is the commission. So it just adds into the cost base as if I paid a little bit more for the stock. And when I sell, the commission is also as if I sold it for a little bit less than what I actually sold it for.
Oh, that makes sense then.
Yeah.
Thank you, Alesh and Girish. Thank you.
Yeah, these are good questions, and if you wake up in the middle of the night and like, oh my God, I forgot, then feel free to text me.
Yeah, the brokerage accounts are really good, Kenny. If you go to your history of transactions, you would see literally every single entry in it, and you can go back and track for 10 years, 15 years. It's literally, it has everything in it. And everything tax related is been taken care by your broker on your behalf. What you really have to focus on and put a lot of effort in, it's really buying and selling stocks, and have a discipline. That's where 99.999% effort has to go in. The rest of the stuff it's been done on your behalf. You really don't even have to worry about it.
Yeah.
Good to know. Thank you.
Yeah, I just do an export for my accountant, and then he filters it to whatever he wants to see, and off he goes. So another kind of a suggestion is avoid the hot stock tips. At the water cooler at work, everybody's gonna, oh, I love this stock. Yeah, they love it because it's doubled or tripled for them in order for them to love it. And then if you buy it, then yeah, it might go up a little bit more, but now it's likely overbought, overpriced, and you're going to lose money on it. What you want is the one that's been beaten up, but they still have very good feelings about it. So you want the low price and the up and coming, and nobody ever talks about those. They don't talk about the stuff that they lost money on, but they're still holding on because they think it's a valid investment. So the hot stock tips hardly ever seem to work out. Buy wide moat companies. So the wide moat, Buffett refers to it, Morningstar refers to it. It's something, a competitive advantage over competitors, or something that prevents competitor entries. So an example would be a brand name. An example would be having to build new railroad tracks.
Coca-Cola.
Coca-Cola, the brand name for sure, yeah. So it's what's going to give that company a outsized return for the foreseeable future, because they have some sort of an advantage. Now, like building pipelines, I would have thought would be there as well, because it's really expensive. But I think like Enbridge and places like that either have no moat or a narrow moat. So anyway, just something to think about, that you're looking for something special about that company. Now, the odds are it's already been priced into the stock, but if you hold it, it might have a bigger impact than maybe what's been priced in. So here's Bank of Montreal. This is from 6 months ago. So there's the fair value that we talked about. This is a Morningstar screenshot, and their economic mode is narrow. I guess it's mostly brand name recognition. I don't think it's that difficult to set up a bank.